Write the heading SA-560 subsequent events. What did he say? Please copy. All photos will be there in police station now. All CA wanted. CA wanted. See, please concentrate on copying. Copied, can I turn the page? Okay, fair enough. Now copy. Are giving, you at least copy this much. Giving, 2 minutes. Can I turn the page? Okay, let's start. Pay attention. Now, the next standard that we are studying is subsequent events, SA-560. So far, how many standards we have done? Which are they? 705. What was 705? Modification of auditor's opinion. What was 706? Emphasis of matters and other matters para. What is 501? Audit evidence on specific items. And now what we are doing is 560, which is subsequent events. Pay attention. Now when we are talking about subsequent events, how does the concept works? Please listen carefully. What do you mean by subsequent events and how does the concept works? Look at this word subsequent. Subsequent means afterwards. Okay, I would say that in accountancy there is a standard AS4. there is a standard AS4 which is called as events occurring after balance sheet date. The name of this standard is events occurring after balance sheet date. So what I am teaching you in SA-560 is somewhat relevant to what is mentioned or somewhat similar to what is mentioned in accounting standard 4. So 560 and accounting standard 4 both speak on the same point, which is events occurring after the balance sheet date. Now I require your understanding, so don't talk, just pay attention. Events which occur after the balance sheet date are known as what events? Subsequent events. I have given you a small example. This is a timeline which shows that this period we call this in accountancy and in law as per section 211, this period is called as financial year. Companies Act section 211, according to Companies Act, this period is a financial year. So a period starting from April ending on 31st March is a financial year. There are some transactions which take place in this period. There are also some transactions which may take place after this period. Now understand properly. Suppose for example in this period you sold goods, okay, you sold goods on credit basis. It is possible that the creditor may make you the payment somewhere in this period, okay, after the balance sheet date gets over. So it's not necessary that if you make a sale, suppose if you make a sale somewhere very close to 31st of March, it is possible that the debtor will make you the payment here on this point. So you made a sale here and you are receiving money from the debtors and this period. Now what happens, when the debtor gives you the money, fair enough, and suppose if the auditor on this date, after the debtor has made you the payment, the auditor is going to sign his audit report, okay, the auditor is going to sign his audit report. See, to teach you this standard, first I have to take you to the Companies Act and teach you some points from the Companies Act. That is why there is a simple diagram which I am drawing. How it works, I'll just show you. First and foremost thing, you must all know this point, that when we are talking about company law, there is a provision in company law that first of all in Companies Act, remember there are two type of meetings. Actually there are four type of meetings, but for us the important ones are only two. They are classified into general meetings, okay, general meetings, my foot, kuch bhi, any rubbish you are talking, what, extraordinary meeting, and board meetings, okay. Anything you talk, nothing is sensible. Now in general meetings you have three categories. You have the statutory meeting, okay, in general meeting you have the statutory meeting. This will help you in understanding the company audit chapter, which is the chapter after this chapter, okay, so pay attention. Statutory meeting, then you would have heard this one, very popular. And now what you said, extraordinary meeting, okay, extraordinary meeting, that is extraordinary meeting. So Companies Act basically, as there are four type of meeting, but for us what is the relevant I am writing here, one is general meeting, second one is the board meeting. Now basically what's the difference between the general meetings and board meetings? What's the difference between general meetings and board meetings? Let us just try to understand. As far as the general meetings are concerned, they are the meetings of shareholders. Whose meeting they are? They are the meetings of shareholders. So general meetings are meetings of shareholders. Whatever points I am writing, you please make an attempt that you are noting down somewhere, okay? Yeah, even if I, see as a CA student, every time I can't say copy, you are not in school, I will say copy. You have to understand when I am writing something, it is implied that you have to write something. Otherwise, how will you understand things? So general meetings are whose meetings? They are meetings of, do you know who will conduct the general meeting? Who will conduct the general meeting? It is conducted by the board of directors. Who conducts general meeting? The board of directors conduct general meeting. Now what you have to understand here, that as far as general meetings are concerned, there are some important decisions taken in the meeting. Like say if I want to appoint the auditor, I have to take that decision in the general meeting. If the auditor has to read the financial statement, he will read out the financial statements and audit report in front of shareholders. That is also done in general meeting. If the company wants to give dividend to the shareholder, if the company wants to buy back the shares, if the company wants to issue bonus shares, such important vital decisions are taken in the general meetings. As far as the board meetings are concerned, they are the meetings of board of directors. These board meetings are called as what? They are the meetings of BODs, board of directors. Okay, who will conduct this meeting? They are conducted also by board of directors. Okay, so they are conducted by board of directors. You know, if I want to appoint an auditor, that decision is taken in the shareholders meeting. So appointment of auditors, where this decision is taken in the general meeting, particularly in the annual general meeting. So appointment of auditor, if I want to give dividends, if I want to make payment of dividends, all these decisions will be taken in the general meetings. Whereas in the board meeting, basically I have to decide about the administration, the future of the company. So when I discuss some administration policies, admin policies are discussed. Management and admin policies are discussed. They will be always discussed in what? In the board meeting. Okay. Now I have just given you a brief idea that as per company law, you can classify meetings into two parts. There are different parts, but for us only two are important. These meetings will study in IPCC and this will study in final CA. Okay, but I will just give you a brief about how it is helpful for us to understand this concept so that we can understand SA 560 and the company audit chapter also. Meetings will be general and board meetings. Now, whenever you want to take any decision in the meeting, remember, in a meeting, if decision is to be taken, you need to pass a resolution. Okay, if you want to take a decision in the meeting, then you should always pass a resolution. So what is resolution? Resolution means acting upon the proposal. When a proposal is kept in front of the members of the meeting, you are just acting upon that. So that means you are taking a decision. That means you are passing a resolution. Okay, have you copied so much? Can I remove this? Now, okay, so coming to one more point here, as far as now let me speak on resolution. Now, do you know in Companies Act, when you're passing resolution, as far as the general meetings are concerned, you will pass two types of resolutions, or you can pass two types of resolutions. Okay, you can pass two types of resolution. So these resolutions can be classified into two different categories based on the business which you are transacting. So suppose if I say that the business that you are transacting is an ordinary business. Okay, if the business that you are transacting is an ordinary business, then it just needs an ordinary resolution. But if you are transacting something as a special business or an extraordinary business, then it needs a special resolution. So resolution can be either ordinary resolution can be either special resolution. Ordinary resolution means OR, special resolution means SR. Now when I say ordinary business, what do you mean by ordinary business? This is that type of business which is mentioned in the articles of association of the company. Any business which the company knows that I have to conduct this business, it is mentioned in the articles of the association. Or I would also put it the other way around. If I am saying that a business is like a recurring business, it's a repetitive activity. Every year this business keeps on happening. I know that I have to give dividend to the shareholder. I know that I have to appoint the auditor. So it's a recurring transaction for me. Okay. So suppose if I'm saying special business, it may or may not be. Mentioned in the articles. Okay. It may or may not be mentioned in the articles of association. So sir, suppose if you are saying it is not mentioned in the articles of association, still I have to transact that business. So then I have to alter my articles. So articles will be altered. Okay. Why I am doing the alteration? Because I need to incorporate that clause first and then I can transact the business. Remember, as a CA, you should know this is all called as good compliance practices. Okay, that suppose if articles is not mentioning something, you should tell the company that sir, if it is not mentioning, first you incorporate the clause and then we can easily pass a resolution for the same. So articles may be altered. Why I am saying may be altered? Because if you are mentioning some business which is not there in the article, then you cannot transact that business first. So special type of business or special type of resolution is passed. It is passed when we are doing recurring business or non-recurring business? We are doing non-recurring. So when we transact something which is a non-recurring business, we may pass a special resolution. And let me again tell you that both these resolutions are passed in which meetings? General meeting. IPCC law paper question. IPCC distinguish between ordinary business and special business. Okay, so ordinary and special business, how it works. Now one more thing here, when I'm transacting any ordinary business, I have already given you some examples. Like suppose the best example which suits in this type of situation will be auditor's appointment. Very good example to explain all these points will be auditor's appointment. If I have to appoint an auditor, let me tell you that here the appointment of auditor can take place only when the shareholder in the general meeting pass an ordinary resolution. So shareholder in the general meeting pass an ordinary resolution, auditors are appointed. Do you know that what is the percentage of votes which is required if you want to appoint? Okay, now somebody will say some weird answers I'll get, 51%, nothing like that, nothing like that. When I say that you need to have some votes, I'm talking about you need to have majority votes. When you read Companies Act section 173, when I'm mentioning this section, you should go home and read. Now today which sections I mentioned just now? 211, you remember? 211. Then I am mentioning 173, so go home and read that section, you'll understand what I'm saying. Majority votes, majority votes. So what do you mean by majority? I can interpret it as what? I can interpret it as what? More than 50%, not 51. If you make 51, that means your client will take money from you back. Okay, so it is more than 50%. So majority votes, when majority votes are passed in favor. So when majority votes are passed in favor of the transaction, then only I can say that the business is transacted. Business is transacted. So if you want to transact any business, first you will have to pass how many votes? Majority votes. So when majority votes are passed, then I can say that the business is transacted. Okay, so let me tell you this point again. I'll repeat. What is an ordinary resolution? It is when a business is an ordinary business which is mentioned in the articles of association, or it's a recurring business like an auditor's appointment, then the shareholder in the general meeting will pass an ordinary resolution. They will give their votes, and if the votes are majority votes, then the business gets transacted. But the case is not the same as far as the special resolution is concerned. Have you studied a concept called as buyback? Do you know that do companies do buyback every year? It's not possible only. Okay, none of the companies do that way. So when I say buyback, if you're doing buyback, suppose today I want to change the name of my company. Suppose my existing company name is say Tata. Tata wants to say I want to become Bata. Okay, so now when I want the new name, is the new name mentioned in my articles of association? No, a change of name clause will be there. So if the change of clause is there, I can easily make a new name. But when I'm making a new name, I have to first pass a resolution here. You know who will pass this resolution? Again, the shareholders will pass this resolution. What board of directors? When I'm saying it's a general meeting going on, how board of directors will come into picture? The shareholders will pass a special resolution. Sir, where they will pass a special resolution? In the general meeting. So shareholders will pass SR in the general meeting, then the company can change its name from existing name to any new name, or maybe say it can buy back. It's a special activity. This is a non-recurring type of activity which is happening. Now understand properly. You need some votes for special resolution also. You need some votes for special resolution also. Here I have written majority. Here I have written majority. Now here I am writing special majority. Here I am writing what? Special majority. Now somebody will say, sir, what is this special majority? That means when I am saying I am taking votes from the shareholders, I should have at least taken votes from more than equal to 75% of the shareholders. And let me also tell you that when I am taking votes, it is implied that the shareholders must be present in the meeting. So those shareholders who are not present in the meeting, I can't take votes from them. The shareholder should come in the meeting, then I can take. So either the shareholder should be there. Suppose shareholder is not well, he is not able to come. He will send somebody called as a proxy. Okay, proxy is a representative of the shareholder. Though proxy cannot speak in the meeting, but proxy can of course vote for the shareholder. Okay, shareholder can even speak in the meeting, just like how I am speaking now, you are listening. Shareholder can speak in the meeting, they can raise arguments, they can raise queries, but that right proxy is not having. Proxy can only come, he can just vote for the shareholder. You know, by chance if the shareholder comes back and starts attending the meeting, proxy can even step back. That means there is the role of proxy comes to an end. So when the shareholder comes and attends the meeting, the proxy can step back. Otherwise, the proxy or the shareholder must be present. So we are counting only those votes. See, whether it is 75% or whether it is more than 50%, we are counting only those votes of the people who are present and voting in the meeting. Have you understood this point? So if I am passing a special resolution, there needs to be a special activity, and once I say I get 75% votes, then I will say that the business is transacted. Then the business is transacted. So if you want to transact the business, that way you will have to require votes of how many percentage? 75% or more than that. Okay, and such. So sir, suppose if a company has 100 shareholders, listen to the example. Suppose if a company has 100 shareholders and out of that say 50 are only present in the meeting, so out of 50, 75% should vote. You got my point? Those 50 who are not there, I am not counting only. So out of 50, 75% should vote, then only I can pass a special resolution. Is it clear? Now why I am explaining you all these points, because they are not only going to help us in CA-560, but they will help us in other chapters also. Now my objective here to tell you that when I am talking about general meeting, how this concept works. See, step number 1 will be, this is specifically for 560, CA-560. What we are going to study just now, this is specifically for CA-560. First there will be a board meeting taking place. Okay, first there will be a board meeting taking place. In the board meetings, what will happen, accounts will be laid. Accounts will be laid. Laid means what? They are already prepared. They are already prepared. So they are prepared draft accounts. They are not final. Why I am calling them draft? Because they are not yet final. They are draft accounts. So accounts are laid. Sir, what do you mean by accounts? Accounts means you will lay down the balance sheet, you will lay down the profit and loss account, and if there is a cash flow statement. Of course, as per the new Companies Act, it is essential to prepare a cash flow statement also, which we have already discussed. So in the board meeting, accounts will be laid. After the accounts are laid, they are approved by directors. They are approved by directors. Sir, can you say who are these directors? These directors can be the managing director, and these directors are the board of directors. There's a different group of MD and there's a different group of BODs. Sir, if the accounts are approved by directors, so if the accounts are approved, afterwards they are also signed by them. They are signed by them. Okay, first they are laid, there's a board meeting going on, all the directors have gathered. In the board meeting, shareholders are invited. No, it is a meeting of directors. I never mentioned only about shareholders. This is which meeting going on? Board meeting going on. So first I told you what is general meeting and what is board meeting. Now I am saying that when there is a board meeting going on, accounts are laid, they are approved by the directors, and afterwards they are even signed by them. Do you know that if you want to sign the accounts, then in that case, section 216 of the Companies Act says, that at least means even more can sign. At least one BOD must sign on the balance sheet. One BOD. At least one MD must sign on the balance sheet. And one chartered accountant must sign on the balance sheet. Now after 2006, when this corporate governance had come, now even one company secretary has to sign on the balance sheet. So these are the 4 people, these are the 4 minimum signatures you will find on any balance sheet, and one signature of CA will be there on the audit report also. The directors cannot sign the audit report, it's only the CA. So CA will sign the balance sheet, these accounts are signed, and afterwards when they are signed, then what will happen? then audit report is prepared. See, CA will prepare audit report when he is assured that what he is signing on the balance sheet is going to mention the same thing in his audit report also. That means if CA wants the director to do some modification, then one more board meeting will be held. Please understand this point. If suppose you don't want to sign right now, the accounts are considered, they are approved, but CA is not happy with the accounts, then again one more board meeting they will call. So this cycle will continue. You know, as per the Companies Act, what is the rule? That you can have n number of board meetings you want, but you should have at least 4 board meetings in the year. At least 4 board meetings. At least 4 board meetings in one FY financial year. एक साल में 4 board meeting कम से कम. How many board meetings? At least. Okay, so 4 board meetings in one financial year. And when I say at least, it is possible to have even more than that. Or you should have 1 board meeting in 1 quarter. A quarter means 3 months period. Quarter. What are you all dicey people? So 4 board meetings in one FY or 1 board meeting per quarter. Okay, this is the rule. That means you can have even more board meetings in one financial year. What I just now wrote here is written in section 285 of the Companies Act. This is not there in your syllabus, but I am giving you the references so that kuch to dimag mein jaye. Okay, so coming back to the point, pay attention. This is not easy. Unless you have not finalized the balance sheet, you will never even come to know how it works. So look here. 1 BOD, 1 CS, MD and 1 CA will sign the balance sheet, and then what will happen, then what will happen? Audit report will be prepared. Then audit report will be prepared. And once the audit report is prepared, now this audit report needs to be signed by the auditor. That means signed by whom? By the CA. Now the audit report will be signed by the CA. Acha, now what will happen after the audit report is prepared? Can I turn the page? So first it will be signed as per the company law. Then audit report is prepared. It is signed by the CA. When a CA is signing the audit report, am I saying that CA has to sign audit report? I am not saying that. That section 227 says CA should sign the audit report. Audit report will have no validity unless the CA is not signing. So CA should sign the audit report. Once the audit report is signed, now what will happen? Financial statements plus audit report will be clubbed together, and they will be converted in the form of an annual report. See, as of now I am only speaking to the point, but annual report has much more things also. It has many more other things also, but that is not relevant at this point of time. So financial statements and auditor's report are clubbed together and annual report is prepared. This annual report is a signed annual report. Why it is signed annual report? Because it contains signed financial statements and signed auditor's report. So this financial statements, when I am putting in annual report, it is section 211. And when auditor is putting his audit report in the annual report, where it is written? It is 227. So signing and putting in the annual report is 227. Signing financial statement is 216 and putting in the annual report is 211. Okay, it is basically section 211 subsection 3C. Now this annual report is dispatched or delivered to the shareholders. Plus it will also contain, this annual report is dispatched along with a notice. And notice will be notice of what? Very good, AGM. And this notice should be given to the shareholders, at least 21 days before the AGM. At least 21 days before the AGM. But in company secretary's rules, there is one standard which has come now, which says that you should give at least 25 days before. But since we are following company law, we will stick to the 21 days concept. So it should be delivered along, what is delivered along with the notice? The annual report along with the notice at least 21 days before the AGM. Now my question to you, you understood this whole cycle? Acha, so what was the first thing where we started from? We started from in board meeting, what will happen? Accounts will be laid, then they are final accounts or they are draft accounts. Acha, then they will approve it. If they approve it, then they become final. So approval, please maintain silence. After approval by the directors, they become final. So after they approve, can I say now they can even sign the accounts? Even the auditor will sign, but auditor will just make sure that what he's signing is what he's going to write in the annual audit report. So if he's going to make some modifications, then he should not sign at this stage, then one more board meeting will be held for that. Okay, see here shareholders are not there. Then audit report is prepared, it is signed by the CA as per section 227, which is his duty to do so. Then afterwards what is happening? The financial statement, auditor's report are put in the annual report, which is delivered to the shareholder along with the notice of AGM. Notice is given at least 21 days before the AGM. Have you understood? Now I am talking about something called as what? Subsequent events. Come back to this point. Subsequent events. What are subsequent events? Events which occur after the balance sheet date are known as subsequent events. See, though I say that these are subsequent events, but these events are also significant. What do you mean by significant? You can't ignore them, very important events. And now as I told you, look here, as I told you, if the sale takes place in this period, it is possible that the debtor makes the payment in this period. Okay, now when the debtor makes the payment in this period, and suppose I have not yet signed the audit report. See, when is the debtor making the payment? Here. And when is the signature happening? Here. After the debtor made the payment. So the rule says that such type of events are called as adjusting event. Now I am explaining you what is adjusting event. They ask a distinguish between in exam, differentiate between adjusting and non-adjusting event. You should say both of them. First of all, they are which events? Adjusting events are those events, the conditions of such events will prevail. Prevail means what? It is existing, will prevail as on the balance sheet date. What is the balance sheet date? See, I have written here 31st March is the balance sheet date. I was knowing on 31st March that the event is going to take place, but I was not having any guarantee when the debtor will make the payment. So suppose if the debtor makes the payment, afterwards I am signing the audit report. Afterwards, if I am signing the audit report, then I can adjust that event. Okay. So suppose what happens here, suppose debtor makes the payment, but he tells me that sir, the sale to debtor is rupees 100, but the bad debts are rupees 8. So I can adjust that bad debts also. Arey, please understand. Apply your mind if any. Okay. What I am saying, that sales made to debtors 100 and now he is making payment, but he is incurring a bad debts of 8 rupees, I can adjust that. But suppose if the debtor tells me that sir, I became insolvent. You understood what I said? I became insolvent. Acha, was I aware of this fact that the debtor is going to become insolvent? See, when I make if I know that the debtor is going to tell me that I become insolvent, I will never sell him only the goods. Okay. So if I am selling him the goods, it is going by the fact that he is going to make the payment. So now this type of event is a totally new event. The standard says that you cannot do any adjustment for a totally new event. Then you treat them as what? Non-adjusting event. When there is a totally new event, you cannot do anything. You treat them as what? Non-adjusting event. So sir, how do we treat non-adjusting event in books? We don't make any adjustment. We just have to disclose those events. Sir, where to disclose those events? Notes to accounts. Okay, you have to make a disclosure. What disclosure you will say? You will say that the debtor has become insolvent. He can give you a reason also that due to a fire in the factory, now I have no money to pay, my all goods are destroyed, everything is gone. Okay, what I have written here, insolvency, this has been asked 7 times in exam, IPCC exam. They will give you this condition. The debtor approached to the client stating that he became insolvent, comment as an auditor. So you should say that when the debtor is approaching to the client saying that he is insolvent, as per accountancy AS4, it is considered as a non-adjusting event. What best management can do, it can just disclose such events in the notes to accounts. See, because if I was knowing this fact earlier only, it's a new condition. I was not knowing this condition. Had I known this condition, I would have adjusted that. But if I don't know how to adjust it, so I am disclosing this condition. That what is the reason because of which nothing is recoverable from the debtors. Okay. But now the problem comes. Now the problem comes when the subsequent event is taking place. Please understand. When the subsequent event is taking place, it is possible that when subsequent events take place after financial statements are signed. Tell me, when will the financial statements be signed? In the board meeting. After board meeting, auditor will prepare his audit report. Acha, if the financial statements are signed, who is signing authority? I have already told you. Who is signing authority? This is the minimum signatures required, and now the even company secretary is also required to sign on the financial statement. So if financial statements are delivered to the shareholder, can the auditor do anything now? Suppose if the financial statements go to the shareholder, what will the auditor do now? Nothing. So when I'm saying he cannot do anything, that means it is not possible for him to incorporate the effect of subsequent events. But if the financial statements are not yet delivered to the shareholder, the auditor can modify his audit report. Have you understood this point? That means that timing which I taught you, that the chart which I taught you helps you in understanding this point. Otherwise it is becoming difficult for us to understand when he is trying to modify his audit report. That means he is trying to incorporate the effect also. Now somebody asked me a question, sir, suppose if the audit report is signed, and after that a subsequent event occurs, what will the auditor do? So you have to see two things here, whether it is delivered or whether it is not yet delivered. To whom? To the shareholder. Sir, if he is delivered to the shareholder, can you do anything? So you should write here, then nothing can be done. Okay, then nothing is possible, nothing can be done. But practically how it works? The auditor will read out the effect of that subsequent event in the annual general meeting. He will at least communicate to the shareholder that this event took place, but since you already had the report with you, I could not even modify my audit report. Have you understood this point? Acha, if it is not yet delivered, then what you should do? Modify. That means you should incorporate the effect. Of subsequent events. Have you understood this point? That means if the audit report is still lying with you, not yet gone. Acha, but remember one thing, it is signed, then you are modifying it. That means you are modifying your original signature audit report and giving a completely new audit report with a new opinion. But suppose if the audit report is not yet signed, then you could have easily incorporated the effect of subsequent event. So the confusion does not comes at, you can easily incorporate, the confusion comes at this stage. So I am making it very clear. This para what I have written here is exclusively mentioned in 560 standard, SA 560. You will not find this para in AS4. This is not there in accounting standard 4. That means in AS4 you will just find the definition, what is adjusting event, what is non-adjusting event. But suppose if the definition does not holds good, then what should auditor do? That is not mentioned only. That is why I am writing it here, that if auditor is able to modify the audit report, fair enough, and he will be able to do so only when it is not yet delivered to the shareholder. But if it is gone to the shareholder, then even he can't do anything. Have you understood this point? This is exclusively SA 560. Is it clear or not? Please read it. It's done. Have you finished reading the standard? Last point. Please copy all these things. This is logic. Otherwise, how will you understand? You will not find this in books also. So that means you have to understand here only properly. From where you want to copy? This is copied. This one is copied. So you copy this.